Analysis of a company's balance sheet provides insight into the company's liquidity and solvency, as well as the economic resources controlled by the company. Liquidity and solvency analysis helps to determine the company's technical insolvency and legal insolvency risk. Technical insolvency is when the company has adequate asset but it lacks the liquidity to pay its maturing obligations on time. Legal insolvency, on the other hand, is the inability of the company to have sufficient assets to pay off its maturing or outstanding liabilities. Liquidity here is the ability of a company to meet its short-term financial commitments. The focus of the assessment here is the ability to convert assets to cash and then be able to pay operating needs, including current liabilities, on time. Solvency, on the other hand, is the ability to meet the company's financial obligations over longer term. The focus of the assessment in solvency analysis is on the company's financial structure and its ability to pay long-term financing obligations. In other words, liquidity and solvency analysis are used to assess the liquidity risk and solvency risk of the firm respectively. A company may have sufficient amount of assets available and hence there may be no risk of legal bankruptcy. However, it may not have sufficient amount of cash and other liquid assets to pay off its immediate or near-term maturing obligations. The tools used to analyze balance sheet and hence assess the liquidity and solvency of the company include common size analysis and balance sheet ratios. Common size balance sheets are just like common size income statements, where we learned that each item of the income statement was represented as a percentage of total revenue. Here, in common size balance sheets, we calculate every line item as a percentage of the total assets of the company. As we noted for common size income statements, common size statements facilitate the comparison across time periods, which is called time series analysis, as well as across companies, which is known as cross-sectional analysis. This is because the standardization of each line removes the effect of size from the financial statements. This is also known as vertical common size analysis, as each line item is represented as a percentage of total assets vertically. Here we have the balance sheets of company A, B and C presented, and we see that company A and B are relatively smaller in size compared to company C. They are both the same size in terms of total assets. However, there are variations across line items for the three companies. Because of size differences, the comparison of the three companies may not be that much effective and efficient. Therefore, we need to convert these three balance sheets for the three companies into common size format. The common size balance sheets for the company A, B and C are provided here. Each line item of the balance sheet has been represented as a percentage of total assets for each company. If we analyze the liquidity of company A and B, for example, because they were of the same size, we see that company A is more liquid compared to company B as well as company C. The current assets of company A are 77% of total assets, while company B has 68% assets as current. At the same time, company A has no current liabilities, while company B has current liabilities that are 77% of its total assets. Therefore, company A has more liquidity and is in a better position. However, company B will struggle to pay its total current liabilities. It has total assets that are 68% of assets, while its liabilities are 77% of assets. Therefore, it has insufficient current assets to pay off its current liabilities. To pay its current liabilities, company B may need to collect some of its accounts receivable, sell more inventory, borrow more money from bank, and raise long-term capital, for example. We can also observe that company C is more liquid than company B. Though the current assets of company C are only 52% of total assets, which is less than company B, however, it has only 6% total current liabilities as a percentage of total assets. The composition of current assets also affect the assessment of liquidity. Most of the assets of company A and B are current assets. However, company A has nearly 60% of its total assets in cash and short-term marketable securities, whereas company B has only 6% of its assets in cash and marketable securities. Therefore, company A has superior liquidity position compared to both company B and company C. Solvency is assessed by examining both the capital structure of the company as well as its coverage ratios, that is the ability to generate income and cash flow sufficient to cover both interest and principal payments. However, here we are focusing only on balance sheet analysis, and the coverage ratio requires inputs from cash flow statements as well as income statement. We will leave them for a later discussion. Here in our case, company A is the most solvent of all the three companies. It has 100% of its assets financed with equity, and no liabilities are used to finance assets. Both current liabilities and long-term liabilities are zero. On the other hand, for company B, only 23% of the total assets are financed with equity and 77% of the remaining are financed with debt. The higher is the proportion of debt used to finance assets, the lesser is the solvency of the company, that is, the higher is the financial risk. For company C, we see only 2% of the assets are financed through equity and 98% are financed through short-term and long-term liabilities. This means that company C has the highest solvency risk, that is, it has the highest financial risk and will be considered low on solvency measures. Also note that 92% of the assets of company C are financed through long-term bonds payable on which interest is an expense that is paid. Hence, the coverage ratio, if we calculate here, would also indicate higher solvency risk or financial risk for company C. Also note that we have rounded the percentages here and have ignored the decimal places. We can also make other observations. For example, company C has made a greater proportional investment in property, plant and equipment. Possibly it manufactures more of its product in-house. Company B's balance sheet shows goodwill. This signifies that it has made one or more acquisitions in the past. In contrast, the lack of goodwill on the balance sheet of company A and company C suggests that these two companies may have pursued a strategy of internal growth, which is also known as organic growth, rather than growing by acquisitions. Also note that company A has relatively little inventory or no accounts payable on its balance sheet. It has either not yet established trade credit or it is in the process of paying off its obligation as it being in liquidation. It may be thus a startup company or a company that is at the liquidation stage. However, you must keep this in mind that being more liquid or more solvent does not translate into a better company. At extreme, the most liquid and most solvent company would have only cash as an asset on its balance sheet and will be 100% financed by equity and therefore no debt, but it could not be considered as the best company. A wide range of factors affect a company's liquidity management and its capital structure. Balance sheet ratios are called balance sheet ratios because both the numerator and the denominator involve balance sheet items. Each of the line item on the vertical common size balance sheet is a ratio because each line item is expressed as a percentage of the total assets on the balance sheet. Other balance sheet ratios compare one balance sheet item with another. For example, the current ratio takes the current assets from the asset side of the balance sheet and compare them against the current liabilities on the liability side of the balance sheet. Liquidity ratios measure the ability of a company to meet its current liabilities. The three most common liquidity ratios are current ratio, quick ratio, which is also called the asset test ratio, and finally the cash ratio. Current ratio is calculated as current assets divided by current liabilities, and it measures how many pounds of current assets the company has to pay each pound of current liabilities. A higher current ratio indicates higher level of liquidity. A current ratio of 1 would indicate that the book value of current assets is exactly equal to the book value of current liabilities. That is, for each 1 pound in current liability, the company has 1 pound in current assets. If the current ratio is 1.5, it means for each 1 pound of current liability, the company has 1.5 pounds available in current assets. A lower current ratio indicates less liquidity, which implies that the company will rely more on operating cash flow and outside external financing to meet its short-term obligations. Quick ratio is a more conservative measure of liquidity as it includes only the most liquid assets in the numerator. That is, it does not include inventory as part of current assets. The numerator is adjusted to include only cash, marketable securities, and receivables, while the current liabilities remain the same. Quick ratio reflects the fact that inventory might not be easily and quickly convertible into cash. There is a risk that the inventory may become obsolete, or it may not be fully sold at the value equal to the carrying value reported in the balance sheet. If inventory turnovers are low, then it is indicating that inventories are illiquid. In such cases, quick ratios are a better indicator of liquidity relative to current ratio. Cash ratio measures cash and marketable securities in relation to current liabilities. It reflects the number of pounds available in cash and marketable securities to pay 1 pound in current liabilities. A cash ratio of 1 indicates that to pay 1 pound in current liability, the company has 1 pound in cash and marketable securities available. The higher is the cash ratio, the better it is, just like in the case of quick and current ratios. Similar to quick ratio, which does not consider inventory for certain reasons, the cash ratio also excludes receivables, considering that there will be a time lag involved in turning receivables into cash, and there is also uncertainty in terms of the amount collected on conversion or collection. Generally, cash ratio is considered a reliable measure of an entity's liquidity in a crisis situation. However, in general market crisis, the fair value of marketable securities may also decrease significantly as a result of market factors. In that case, the cash ratio might not provide reliable information also. Solvency ratios indicate the financial risk and financial leverage as well as a company's ability to meet its financial obligations over time. The more a company borrows or uses debt in its capital structure, the higher will be its financial risk and the lesser will be its solvency. Except for coverage ratios that we will discuss later, all other solvency ratios that are from the balance sheet, the higher is the ratio, the higher will be the financial risk and the lesser will be the solvency of the firm. The names of the solvency ratios are self-explanatory. So the long-term debt to equity ratio is the total long-term debt of the company divided by the total equity of the company. Similarly, the debt to equity ratio is the total debt of the company divided by the total equity of the company. Here, debt includes both short-term and long-term debt on which interest is paid. The total debt to total asset ratio is total debt of the company divided by the total assets of the company. Again, total debt includes both short and long-term interest-bearing debt. The debt to capital ratio is total debt of the company divided by the total debt plus total equity. And finally, the financial leverage is the total assets of the company divided by the total equity. For all these ratios, the higher is the ratio, the weaker is the solvency of the company and the higher is the financial risk of the company.